This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We now know how to deal with every source of income that may have to be included within the income tax computation. We can analyse it in terms of the required analysis columns to know what tax rates are applicable to which amounts of income, they being non-savings, savings and dividend income. We work firstly to total income. And up until now, total income and net income we've taken as being effectively the same thing. Though if you look back to the beginning of the chapter on our pro forma computation, you will see, as indeed is noted in these notes now that you can see in front of you, that there are some, and there's only a couple of deductions that may be made from total income in deriving the net income figure. So what are they? First one that we see here, and as I said, there's only two that we need to be aware of in relation to our syllabus. The first one is qualifying interest. Now again, as we said in our introduction to the chapter, that there will be many taxpayers paying interest within the UK on various things. Loans, obviously, but on bank overdrafts, on credit card statements, loans to buy a house, the house in which they live, presumably, and also maybe on loans that they've taken out to buy a car. Very, very few of those sources of interest that are paid, in fact, none of the ones I've just mentioned there, are going to attract tax relief as a deduction from total income in deriving the net income. So what do we have? They're all business related. So the first one, a loan to purchase an interest in a partnership or a contribution to the partnership of capital, or indeed a loan. We're borrowing to put money into a partnership, a business. We're borrowing a loan to purchase plant or machinery used in the business by a partner. Again, to do with that business, buying an asset for use within that business. On a loan, slightly different one here, to purchase plant and machinery by an employee if used in the performance of duties. Now, it's an odd one. You would expect that if an employee requires certain plant and machinery to be able to do their job, they wouldn't have to buy it for themselves. But in certain circumstances, if that is the case, probably a remnant of the past in all honesty here, but that is still an example of where, if the individual has had to borrow to buy such plant, then any interest they pay on that loan will be tax relievable as a deduction from total income. One here where a new term will come up, but you do not need to define it, but a loan to purchase an interest in a close company. Now, the close company legislation is not a part of our Tax UK paper. That belongs at advanced taxation. But basically, a close company is an owner-managed company there. All you've got to do is to be able to recognise the term. That is, if they tell you in a question, had borrowed this amount in order to, again, buy an interest, buy shares in or lend money onto, indeed, a company, that it was a close company, then the interest that is paid thereon is tax relievable. So there, bit of a learning exercise, nothing to worry about at this stage. I wouldn't even try to learn it at this stage. Be aware. And then as you come to questions and you see examples involving loan interest, you can come back if needs be and check it out with the notes to see whether that is allowable. Of course, you'll also see from the answer to such a question whether it is or it is not allowable. So you do it in that way. You don't sit there with those four in front of you and try and learn them. Wasting your time. Don't worry about it. Certainly not at this stage. What will prove to be a much more important area in terms of a deduction now from total income is this one, loss reliefs. Again, if you recall back to our very first lecture looking at the pro forma, we saw that there were indeed deductions from total income. You saw trading loss reliefs on that pro forma computation coming in right at the top of the computation, a direct deduction from trading income. That's where we had a trading loss brought forward. But what we also said, after total income, certain other loss reliefs. And those other loss reliefs are mostly, again, ones where you've actually incurred a loss this tax year in the basis period assessable from your business in this tax year. You put a nil assessment in. We never put a negative in. Again, we'll explain this in Chapter 7. And because you made a loss, you are able to offset that against the other total income of the tax year. You don't have to do it. It is a choice available to you. Indeed, you can set off against the total income of the current tax year and or the preceding tax year. And of those two, it's probably the preceding tax year that is most likely. But fear not, we'll be looking at all of those individual loss reliefs and how they work and what guides us in trying to get the best use out of any loss that has been sustained in terms of the reliefs available. All of that is in Chapter 7 there. So, little example involving loan interest. Calculate Kathy's income tax liability. Again, we always look what the question's requirement is. Got a trading profit there, non-savings, 52,000 in the year, and paid £1,000 interest on a loan to purchase plant and machinery used in the business of a partnership. You can quickly check back, but that of course is on our list above and therefore able to be deducted. Now, I'm going to get you to have a go at this one. There's only one source of income. It's non-savings. You don't even have to worry about doing a non-savings and a total column. They're one and the same. Obviously, the answer will show that. But you can see, you got a trading profit of 52,000. No other income. So your total income is 52,000. We've then got that interest payment. Is it an allowable interest payment? Yes, it is. It is therefore an allowable deduction. So your 52, your total income will be reduced by £1,000 down to 51,000. If you've got then net income of 51,000, total income less the qualifying loan interest payments, then from the net income we deduct our personal allowance. No worries in terms of that figure of net income. It doesn't exceed £100,000. So on that basis, we get a full personal allowance. Take it away, get your taxable income. It's all non-savings. Proceed to tax that non-savings. So I'll give you, well, about a minute or two there, probably all that you need to work that exercise through. We'll quickly check it, and then we'll move on to probably the rather more important area in terms of this particular lecture, and that's payments made to a charity under the so-called gift aid system, and also, it is the same way, personal pension contributions paid by the taxpayer in the tax year. But more of that in a moment. You have a little go at that example first of all, please. Okay, hopefully no surprises here. As we said, 52,000 of non-savings income. That is total income. Take away your qualifying loan interest paid, down to net income of 51. No problem, a full personal allowance is applied, 12,500, and we've got taxable income of 38,500, which is all non-savings. Basic rate band limit, 37,500. So to that, we pay tax at 20%, and thereover we pay tax at 40%, something you are well familiar with now. And in that way, we establish our overall income tax liability. Nice, simple exercise there, I trust, to warm us up indeed in terms of this particular lecture. Okay, back now to our notes, where we said, rather more important than what we've just done, these payments being made by the individual taxpayer to a charity, but in a tax-efficient way under the so-called gift aid system. Now, I'll explain to you how the gift aid system works to give you a bit of background on it. You're never going to have to do that. What you have with tax, as we've said so many times before, is a series of rules. What you don't want to be doing, and what you should not be doing, is ask, why do we have that rule? Tax is not a question about why. The issue is, as I keep on saying there, it's an is, not a why. That is what we do. Individuals in power, in government, through HMRC, make rules. Different people can make different rules. We just apply those rules. Again, at this level, this is not a philosophy exam. You simply have to know the mechanics of the system. Follow the principles. So I'll explain to you about the gift aid system in a moment's time, but then we'll sum up at the end These are the simple basic rules of what you do and how it impacts upon the income tax computation. And the system that we deal with in terms of the techniques shown within the income tax computation for gift aid, we apply exactly the same mechanics in terms of how we put together our income tax computation when dealing with a particular type of pension contribution that may be paid by the taxpayer during the tax year, and that's referred to as a personal pension contribution. I think we may have mentioned this before, but pensions have their own chapter, Chapter 10, that we'll be looking at in far more detail, and they're dealing both with personal pension contributions and the only other type of pension that you need to know about, an occupational pension scheme, which is where you are an employee and your employer operates a pension scheme for the benefit of its employees. If you are an employee and your employer does not operate such a scheme, or you are not an employee, you are self-employed, then if there is no occupational pension scheme available to you, the only pension scheme available to you is personal pension. It is that one that we'll be dealing with here. Again, as I go through, I'll talk you through what is happening, but don't worry about the why aspect. Don't try and rationalize that. What is important is when given these numbers with these descriptions in a question, this is what you do. Don't ask, why do we do it? Just do it. Right. The gift aid system is a tax efficient way by which to give money to charity and is available to individual taxpayers, i.e. it is not something that companies, corporate organisations can do. This is only for individuals. Individuals, as we know, may be basic rate taxpayers, may be higher rate, may go as far as additional rate taxpayers. If you are a basic rate taxpayer and only a basic rate taxpayer, then there will be absolutely no involvement in relation to your gift aid payment or your personal pension contribution in the context of the preparation of the income tax computation and the calculation of taxable income and then the basic tax liability. I'll explain to you how it is tax efficient. Right, basic rate taxpayer. If I've got £100 worth of income as a basic rate taxpayer, then on that I'm going to suffer a 20% basic rate tax charge. So I started with £100 worth of gross income. I've now suffered 20% income tax. I'm left with a net of £80 after basic rate income tax. If, of course, I'm an employee, not that we know the calculations yet, there's national insurance contributions to work out your actual net income. But in terms of income tax, as a basic rate taxpayer, for every £100 gross, I end up with £80 net after 20% tax. Right. What now happens is, if I am a generous soul and I wish to give to charity, I could simply dip into my pocket and pull out £80 worth of cash and put that in probably a very surprised charity collector's bucket as they wave that at me as I walk down the street on a Saturday morning there, and I could give that to charity. If I did that, then the charity would just get the £80 that I've given to them. You might be thinking, how could they get anything else? That's what you've just given to them. But if we go through the gift aid system, what happens is I give them the £80, I state that I am a basic rate taxpayer and I am willing to make this payment under the gift aid system. What that then allows to happen is the charity take my £80 that I personally have gifted to them, and they're then able, with that gift aid statement, to go to Her Majesty's Revenue and Customs and say, right, this individual has given us £80, they are a basic rate taxpayer. Therefore, they had £100 of income and they gave us their net £80. We therefore are now claiming off HMRC, and HMRC will give to them the £20 tax that they took from me on that £100 worth of income. So they collected £20 tax off my £100 £100 income, but that left me with 80, and because I was generous enough to give that to a charity under the gift aid system, when claimed by the charity, the government, HMRC, will then pay over that £20 tax that they took from me and give it to the charity. So from my £80 net payment, they end up with a gross amount of £100. Clearly, that is hugely beneficial. That from 80, they can get 100. On their net 80, that's an extra 25%, an extra £20 on top of that. That's a huge increase in the charitable donations collectible by a charity, if we indeed, as basic rate taxpayers, are happy enough to make that payment under the gift aid scheme, which logically we would do. It doesn't lose us anything. We've suffered that tax at source anyway. Where would I rather that £20 go to? Staying with the government for all sorts of expenditure I might not agree with, or going to my favourite charity? It's a win-win, so far as me and the charity are concerned. If I want them to have £100, I don't have to give them 100. I give them 80, they get the other £20 off HMRC. Now that's the rationale behind the system. You don't have to know that, but everybody asks, why do we do that then? That seems very odd. That's it, and that's as much as I'm telling you about it. What we've now got to look at is how, when presented with a gift aid payment, whether you are a basic rate taxpayer to begin with, or a higher or an additional rate taxpayer, what do we have to do to deal with that on our income tax computation? Now, just have a little read through here in relation to basic rate taxpayers in the context of what I've said. As we've said, the payments to charity under gift aid are treated as being paid net of the basic rate of tax of 20%. I paid 80 out of my gross of 100. I suffered basic rate tax of 20% on that 100. For a basic rate taxpayer, tax relief at the basic rate is automatically obtained as payments are made to the charity net of basic rate relief being given at source, i.e. to give a charity £100, the taxpayer need only make a gift aid payment of 80. As we said, the charity will then be able to claim back from HMRC the basic rate of £20 that had been collected by HMRC from me out of my income. But the donation then is not shown as a deduction in the calculation of taxable income. We are never going to see these payments showing as deductions against the income of the taxpayer in determining our taxable income figure. A question may tell you what is the amount paid by the taxpayer, for example, as in my example, £80, and then you must gross this up. And if that is the net of 20% tax having been deducted at source on the gross amount, 80 is the 80%, so times 100 over 80. So we've got £100 therefore as our gross gift aid payment. So we do that to compute the gross figure. Clearly it's 100. What a question may say is state the amount paid as being £100 gross. It is the gross figure there. So you don't have to do any other work. That is the amount. So they give you that figure. So again, as ever, read the information carefully. But if you are only a basic rate taxpayer, it doesn't have any impact at all in relation to your income tax computation. It's ignored on the face of the computation. The system has worked without any involvement of any amendment, any adjustment to the income tax computation. You paid your £80 to the charity gets the other 20 off HMRC. That was your tax you paid to them. They end up with £100. The system has worked. So you're not likely to see that happening in an exam question. You are far more likely to be a higher rate taxpayer, maybe even an additional rate taxpayer. Then it is going to have an impact on the income tax computation. Not, as we have said, in the terms of deriving your taxable income. Whatever level of taxpayer you are, that gross gift aid payment that needs to be established is never deducted in deriving your taxable income. So what happens, therefore, if you are a higher rate taxpayer. Now, if you are a higher rate taxpayer, then 40% tax relief is available to you and will be given. Now, you know that you've got basic rate relief at source. To give the charity a gross 100, you actually gave them a net £80. You got your basic rate relief at source. But if you're a higher rate taxpayer, then we do get higher rate relief, i.e. 40%. So 20% relief has been given at source, you paid your 80, they got 100. Then the extra 20% to bring us up to 40% higher rate goes through the income tax computation. And this is the bit that you need to know. You don't have to worry it's 20% here, 20% there. What you need to know is, what do I do on my income tax computation? And before you attempt to calculate the tax liability, we are used to using a basic rate band limit of £37,500. When we come to it, a higher rate band limit of £150,000. Well, before we do the tax calculation, if there are gross gift aid payments or indeed gross personal pension contributions identified within the question, then we take that gross amount. If we're a higher rate taxpayer, what do? We extend the basic rate band, again, always using the gross figure, by the gross donation or the gross personal pension contribution. And what that does, now again, all you've got to know is, if the question said, made a personal pension contribution, made a gift aid payment, this is a rather big number for a gift aid payment, but of, say, £4,000. That is a net figure. If the question said gross gift aid or gross personal pension contribution, 5,000, obviously they said that is the gross figure. If it's paid net, then it is paid net. If they give you that amount paid, it is the net figure. What do you do with it? 4,000 times 100 over 80 equals £5,000. Or they just tell you, gross payment, £5,000. If we're a higher rate taxpayer, when you come to do your tax calculation to derive your tax liability, before you start to put down any of the calculations, you revise. Firstly, and if you're a higher rate taxpayer, it will only be this particular band limit, you'll revise the basic rate band limit. You will add that gross figure. You will extend that basic rate band limit from 37,500, the usual set figure as per the rates and allowances, by the gross payment. That was 5,000. Add 5 to 37,500, you've got, I think, 42,500. And then you proceed to use your tax bands and tax rates as you have ever done. Non-savings followed by savings followed by dividend income there. And the only difference is, instead of basic rate stopping at £37,500 of taxable income, you've extended that band limit by the gross payment of 5,000 to 42,500. The way that effectively gives you your higher rate relief is you've just taken £5,000 of your income that would have otherwise have been taxed in the higher rate band at 40%. And by extending the basic rate band limit from 37,500 to 42,500, i.e. by 5,000, you have taken 5,000 income out of the higher rate band, where it would have been taxed at 40%, and put it back in to the basic rate band, where it's only taxed at 20%. So there's your differential. There's the 20% saving that you've received, moving income out of higher rate and back into basic rate band. Now, that self-same gross figure, if you are an additional rate taxpayer, would extend the higher rate band limit. Now, the higher rate band limit, the point after which additional rate at 45% kicks in, is £150,000. What we will therefore do is to now add that gross gift aid or gross personal pension contribution, whatever the gross payment is, 5,000 to 150. So you would have, in the example I've just given to you, a little working that will identify, before you do your tax calculation, firstly the revised basic rate band limit. It would now be 37,500 plus 5,000 equals 42,500. And if your income was above 150,000, then you'd also identify the extended higher rate band limit, 150,000 plus the gross payment of fine, 155,000. And when you've got those relevant revised basic rate band and higher rate band limits as applicable, you can then proceed to do your normal tax calculation as we have said. Now, that information you can find here written in the notes that I have just explained to you. Again, one other little thing in here is just a little planning issue, and that is about when you actually make those payments, what you're able to do is to elect to treat any gift aid payments, and this is purely gift aid payments, not now relevant to pension contributions, but any gift aid payments made by the 31st of January within a tax year to have been made in the previous tax year. You can backdate the effectiveness of this gift aid payment. So, a payment made by the 31st of January 2021, so that's in the 2020-2021 tax year, 6th of April 20 to 5th of April 21, can be treated as if it had been paid in the previous tax year, or what precedes 2020-21, that's going to be 2019-20. Why would you do that? Well, this would be advantageous if the taxpayer was likely to be a basic rate taxpayer in 2021, but was a higher rate taxpayer in 1920. You'd far rather get higher rate relief than merely have basic rate relief there. It would also be advisable if in 1920 the taxpayer had adjusted net income between 100,000 and the 125,000. Now, we've recently looked at that, haven't we? When your adjusted net income goes above £100,000, you start to lose your personal allowance. By the time you get to 125, you have lost the entirety of your 12,500 personal allowance. That was based on adjusted net income. Now, if you remember, in section 4, that was, I think back on page 9, that both gross gift aid payments and gross personal pension contributions are deducted in arriving at the adjusted net income figure that is used to restrict the personal allowance of the taxpayer. So anything that can reduce that adjusted net income, remember, the adjusted net income is not a figure that is included on the income tax computation. From the income tax computation, you take net income that is unaffected by these payments. In a separate working, you then compute adjusted net income, and from net income, we deduct gross gift aid payments, gross personal pension contributions. And if that brings the adjusted net income down, like I've just said, a gross payment of £5,000, if my net income was £105,000, I now reduce that by the gross payment of £5,000. I bring what would have been 105 down to 100. I therefore avoid any restriction in the personal allowance. But that, therefore, is certainly something that I would wish to do. And that would be a reason why, if I had that issue in the previous tax year, but not in this tax year, I'd be happy to take that back and backdate it to the previous year. Okay, so all you need to know as you read a question and it says about a gift aid payment or a personal pension contribution payment. First of all, do they just tell you amount paid? If so, they must be grossed up because they are both paid net. How do I gross up those figures? Multiply them by 100 over 80. If the question actually says this payment in brackets gross, then I have already my gross figure. What do I do with them? If I am a higher rate taxpayer, I extend the basic rate band limit of 37.5 by that gross payment. If I'm an additional rate taxpayer, I extend the higher rate band limit, 150, by that gross payment. With those revised limits, I then proceed to do my normal calculation of tax liability. Preliminarily to that, prior to that, if I have a net income figure that is in excess of £100,000, then in calculating the adjusted net income to determine what, if any, personal allowance will remain to me, to include on my income tax computation, the adjusted net income, as we have just seen here, is after deducting any such gross payment. So that must be done first to determine the personal allowance. Then when you come to your tax calculation, remember to extend the relevant limits for the higher rate taxpayer and then in turn for the additional rate taxpayer. Okay, so look at what we have here therefore in terms of example 13. Again, a relatively simple one in as much as we just have one source of income, trading profit, non-savings. 1920, we've got to get income tax liability for 1920. He paid £1,600 to charity under the gift aids system. It does not say next to the £1,600 in brackets gross. Therefore, the amount paid is the net figure. So what do we do? Times 100 over 80 to give you the gross figure. You put together your income tax computation. One figure. Non-savings, 53,000. That is your total income. That is your net income. My personal allowance to deduct from net income to give me the taxable income. Is my net income in excess of £100,000? No, it isn't. It's only 53. So I get the full personal allowance. Take my personal allowance from my net income. I have my taxable income. Now then, before I attempt to determine, am I just a basic rate taxpayer? Am I basic and higher rate taxpayer? I must revise the basic rate band limit. Clearly here there's no issue of being an additional rate taxpayer, so I can ignore the 150,000 higher rate band limit. But that basic rate band limit, it starts at our benchmark 37.5. It will now be extended by the gross amount of that gift aid payment. 1,600 times 100 over 80. Well, put it through your calculators, but hopefully that's a nice round number of £2,000. So what would have been a basic rate band limit of 37,500 is now extended to 39,500. You then proceed to do your tax calculation on your taxable income, now with a revised basic rate band limit of 39,500. Right, over to you guys now to put that calculation together and see what tax liability you get. I'll obviously talk you through that answer before then we move on to a few more examples to illustrate this technique. Okay, well, hopefully no problems here. As we knew, the trading income was non-savings and that assessment was 53. That is your total income. Take away what is a full personal allowance. Why? Because adjusted net income has not exceeded £100,000. So the full personal allowance of 12.5 comes away. That leaves us with taxable income of 40,500, entirely non-savings income. Now, before we go into our calculation of the tax liability, we need a little working. A working that will revise the basic rate band limit, as we said. We start with, for our tax year, 37,500 plus the gross gift aid payment, which now means we work on a basis of a basic rate band limit of 39.5. Our taxable income is £40,500 of non-savings income. So the first 39,500 is taxed at 20%. The remaining, there is only a further 1,000, is therefore at 40%. Add it up, and that, all being well, will be our income tax liability there. All that required us to do was to recognise we're a higher rate taxpayer, or would otherwise have been in other situations. But if our income has gone above a taxable income of 37.5, we would otherwise be a higher rate taxpayer. Therefore, the requirement to extend the basic rate band limit. If our income had gone above £150,000, then of course we'd be looking at an additional rate taxpayer, and the same extension that we applied to the basic rate band limit would then also apply to the higher rate band limit. And that is something that we're going to see if we now turn our attention to example 14. Thomas earned £160,000 trading profit in 1920. Again, non-savings. This time in the tax year he paid £6,400 to the charity under the gift aid scheme. Now again, it's the amount paid. There's no bracketed gross statement made there next to the 6,400. So that will be times 100 over 80, and that, all being well, will give you a gross figure of £8,000. So what do? We can see here that, again, to keep it simple, the computation contains only one source of income, non-savings, 160,000. That is your total income there. It is also your net income. Then, do we get a personal allowance? Now, we can see that the net income is considerably larger than £125,000. It's 160. And on that basis, there would be no personal allowance at all. Just one little check. It's not going to change this outcome. But adjusted net income is the figure that we need to compare with the £100,000 and the £125,000 figure. And adjusted net income is net income less these gross payments. Now, 160 less 8,000 is 152. 152 is clearly a whole lot bigger there than 125,000. So yeah, there is no personal allowance. So no personal allowance. So the 160,000 was total income, was net income, is taxable income. We would then proceed to tax. But given that we're not just a higher, but at this point an additional rate taxpayer, what must we do with those basic and higher rate band limits? We must extend them by 8,000. The 37.5 goes up by 8,000. The 150,000 goes up by 8,000. You state, well, I say you state, if it's a Section C question, you will state, as you'll see in our answers to this. If, of course, it's an objective testing question, you just do the calculation and pick out, you hope, what is then the correct answer from the four available to you. So, over to you again now. Can you put together that computation and work out, please, as required, the income tax liability for the 1920 tax year? Have a go at that now. Come back and we'll work through it together. Okay, well, hopefully no problems there, given the introduction we had to it. The trading income, non-savings, it is the total income, it is the net income, it is also the taxable income. Again, note 1 in relation to the personal allowance showed us that it had been reduced to nil as the adjusted net income exceeded 125,000. What was our adjusted net income, as we had already determined 152, well in excess of 125, so there's no personal allowance. Before calculating then the tax liability on your taxable income, revise. Here, obviously, both the basic rate band limit and also on this particular question, given the level of income at 160, we will also revise the higher rate band limit as well. So what was 37.5 was increased by 8,000 to 45,500. What was 150,000 increased by the gross again amount of 8,000 is 158. So there is your basic rate band figure, 45,500. We now need to know how much income falls within the higher rate band. It is exactly the same as it would always have been because both the basic and the higher rate band limit have been increased by 8,000. So the difference between the basic rate band limit and the higher rate band limit remains exactly the same. And that amount here is £112,500. There's the working for it, 158 minus 45.5. But that's always going to be the self-same 112,500, which is the same difference as it is between 150,000 and 37,500 pounds. Now, we had 160, so we've gone 2,000 above that higher rate band limit. So that 2,000 in there is going to be taxed at 45% to derive our income tax liability. Okay, hopefully again no problems there. We're almost at the end of this rather long lecture, but there's a little bit of homework that I want you to do here before next time. And that's example 15, where again we need the income tax liability, but it's a bit more interesting question for you to have a go at. Clearly, it's going to involve the gift aid payment. But we've got trading profit of 98. Oops, not a very good straight line there, crossing something out. Trading profit 98,000, and that of course is non-savings. Bank interest of 4,000, savings income. And also dividend income, obviously that is dividends, 6,000. So we got all the examples of the analysis of your types of income. Given what we've done in this lecture, we've also paid interest of 3,000 on a loan to contribute capital into a partnership of which she is a partner. Qualifying loan interest. What do we do with that? That is a deduction from total income to derive net income. Now, when we look at these numbers, 98, 4 and 6, you can see there that we're going to go above £100,000 in terms of our total income. There will be a deduction, 3,000, to derive net income. But that figure will still be in excess of 100,000. So are we going to have a restriction in the personal allowance? Well, you'll only know that once you've established adjusted net income. And for adjusted net income, we need to take account of this, a payment of £4,800 to a charity under the gift aid scheme. So you therefore will list out the sources of income, a normal pro forma computation, non-savings, savings, dividend total. Put your income figures into the correct analysis columns and your total. Get your total income. Take away your qualifying loan interest payment. How do we do that? Not just from total, but what is the order for deductions? Always in that same order as your columns, the non-savings before dividend there. That will give you net income, at which point then in a separate working do an adjusted net income calculation. If your adjusted net income exceeds 100,000, there will be a restriction in the £12,500 personal allowance. If it does not exceed 100,000, then there is no restriction and the full £12,500 would apply. Get your taxable income. Before taxing the taxable income, what must we firstly do? Revise our basic rate band limit and our higher rate band limit if applicable. The higher rate band limit will not be applicable here. We're nowhere near income figures of £150,000. But the basic rate band limit must be extended by the gross amount of that payment. Does it say gross next to the 4,800? No, it doesn't. So what do we do with it? Times 100 over 80 to get that gross figure. Okay, over to you, therefore, to complete that and review through. Make sure that you're happy with it. And then we'll pick it up next time, then dealing with married couples or, again, couples in a civil partnership there, and dealing with jointly owned assets. A few other things to do after that, but we're getting a little bit closer now, at least, to the end of this formidably large chapter. Good news there. Look forward to seeing you next time.